Hi, Ken.
How are you, my friend? Good to see you.
Good to see you as well. How are you?
Very well, very well.
So to start, why don't you introduce yourself and the team that supports the strategy?
My name is Ken Stuzen. I've been at Brown Advisory now since 1997, and I'm supported by essentially most of the people in the equity research team. We take a slightly different view in the sense that we don't assign certain people to a portfolio. We take a holistic approach. So if someone has a good idea, doesn't matter who the analyst is, doesn't matter what their area of coverage is, my door is always open. Best idea wins. So, there's almost 40 people in our research team. There's a smaller group that obviously would work with me more closely because I'm a growth manager and there are certain industries that are growthier than others. But I think of everybody on that team as part of the effort, frankly.
Provide an overview of the strategy's investment philosophy.
We're looking at best-in-breed business models. Now, those business models need to be rather fast-growing. We actually put a hurdle rate on it. We're looking for business models that can reasonably support 14% or better EPS growth through a full market cycle. The significance of 14 is that we think that's a high rate of growth. It is double the long-term growth rate of the broad US market that people would generally use the S&P 500 to represent that. So, as I like to say, we're fishing in that part of the pond where there are very fast-growing companies. Now, to be able to have a 14% growth rate that's sustainable, meaning it's going to last, it's going to be durable, there need to be attributes that company has. The most important one, or amongst the most important ones, are how big is the addressable market that company is going after? And then the other is how keen is the competition in that particular area? There is nothing more ruinous from a growth manager's perspective than thinking and planning for a company to grow at a rate of 16 or 17% a year, but then not having done the requisite due diligence and waking up one morning to find that some other company that you didn't take the time or care to run to ground is taking market share.
Can you briefly describe the strategy's investment process?
We are very much a bottoms-up, research-driven process. And by that I mean the individual research analysts are absolutely critical in constructing a portfolio. I think of my role as allocating capital to the best ideas. Any of those analysts will come forth, talk about a great business model, talk about some of the attributes that I just laid out, and I'm going to allocate capital to them. Now, it's not as easy and as simple as I've just described. It's a rigorous process. I in addition to allocating capital, I think of myself as the chief debater and chief cynic, right? So we're going to challenge each other to make sure that what the analyst envision is something that we think can come to pass. So it's a very iterative process. It's a very team-oriented process, and it's the process that we've been utilizing now for this portfolio for essentially the last quarter of a century.
What are some of the strategy's differentiating characteristics?
First of all, we're concentrated. We only own about 30 names. And I think that that's important because we are not trying to be closet indexers. We are trying to be a portfolio of not a lot of companies, but great companies that have high upside stock potential. And we're trying to best, by a lot, the underlying benchmark that we're competing against. That's very important. You know as well as I do that the benchmark today can be mimicked by someone paying 1 or 2 or 3 basis points, essentially nothing. So our investors are not looking for us to recreate a benchmark. They're looking for portfolios that have high tracking error, high active share, i.e. in plain English, don't look like the benchmark, and that the alpha, the outperformance that we generate, is really based on our ability to pick superior business models and the stocks that represent them.
Describe your approach to portfolio construction. What are some typical attributes of the portfolio?
Yeah, I alluded before to the underlying growth rate, which is important. But in addition to that, and this is where the part of the process that I would describe more as valuation sensitivity comes into play. It's not enough to own a great business model and just put it in the portfolio and go to sleep. We have to understand how we're going to make money in that position. So the team does a huge amount of work of what I would simply call scenario analysis. We are trying to understand the underlying fundamentals of that company, both in the upside and the downside, and the kind of valuation that the market would place in those various scenarios. From that work, we tend to look out 1 and 3 years, or even more, and try to understand how much can we make and how much can we lose in any individual stock over those various time periods. To me, that's a form of risk management.
How do you expect this strategy to perform in different types of market environments?
I expect over long periods of time for us to outperform our benchmark. And the reason I say that is the typical benchmark may have 1,000 or more stocks in it. We're owning a very small number of companies that we think are truly superior in every sense of the word. And so if given enough time and we allow certain market situations where we might, from a characteristic perspective, may not be the best for us, but over time we tend to do very well. When we don't do well would be in instances where the market doesn't care about fundamentals or the market doesn't care about valuations. So as you saw at the peak of the tech bubble in the beginning of the year 2000, we had a very difficult period then. It's not as if our stocks weren't making people a lot of money. We simply could not keep up because, as I alluded to before, we're valuation sensitive. We would have started trimming back from stocks that we thought were getting closer and closer to their upside targets, or selling them completely if we thought that they no longer provided our investors more upside, substantially more upside than downside. So that's the one historical market condition where we struggle. I think many people think that growth stock investors are inherently momentum investors, don't care a lot about valuation, et cetera, are sort of flippant in terms of the deep understanding of the company's financials and the intricacies of the business model. But that's not us. We worry a lot about that. And so if people are interested in just buying any old stock, and those capture a bid without any sort of reference to quality, et cetera, it's going to be hard for us to stay up. But with history as a guide, those are the kinds of companies that tend not to be able to stick in there, right? People will lose faith because the fundamentals give them no reason to trust those kinds of stocks in the long term.
So bringing it all together, why invest in the large cap growth strategy?
I think your question is particularly noteworthy and poignant today in a world where even other fund managers that I've competed against over the last 15 or 20 years, they've been under a huge amount of pressure to cozy up to the benchmark, to not take the risk of not looking like the benchmark. We've taken a very different view. We have been consistent in the application of our process. It hasn't changed in 25 years. And so not changing when it's comfortable to do so, I think puts us in a very, very good place to generate a lot of alpha as we go forward. You know, there'll be times when I look forward a year or two and say, you know what, it'll be hard for us to generate a lot of alpha going forward. Today is not one of those. I think as we get further in this interest rate cycle and we see rates begin to flatten or go down, depending on Fed policy, you're going to see more breadth in this market. You'll see people moving away from this notion of indexation. And I think that will put us in good stead. And if history is a guide, increasing breadth after a period like we've had so far, generally are periods where we produce huge amounts of alpha.
In closing, tell us one thing that people may not know about you as an investor.
I've been at it long enough where they know most of what I'm up to, frankly. But I will say this, and I think about from time to time when I go back to my old business school alma mater to lecture young would-be fund managers. And they always ask questions about, essentially, how did you go from where we are in our seat to where you are now? And so they ask basic questions. What did you major in college? What did you study at business school? And when I tell them my undergraduate major was English literature, you would have thought that I had sort of fallen down in the middle of the discussion. They're incredulous about that. Being an English major taught me, I think, important skills that I use today. Critical reading and analysis. And if you spend enough time reading annual reports and sell-side documents, et cetera, you know darn well there is a lot of close reading of what companies and other investors are suggesting will be the truth going forward. So having a cynical view as to what other people are writing and being able to read very closely, I think has been helpful for me. You've got to teach yourself or learn how to think and be a critical reader, whether it's English literature or history.